Welcome back to the deep dive. Today, we're zeroing in on a really interesting one, a ticker that represents, well, one of the most polarizing transactions happening in the digital asset space. Dynamix Corporation, ticker ETHM.
That's right. We're doing a deep dive into its, let's say, highly unusual pending merger with a company called the Ether Machine.
And it's definitely not your standard merger. That's why we need to walk you through it carefully.
Exactly. Our mission today, really, is to get to the heart of the core tension here. Is this thing, this ETHM entity, is it actually the ultimate regulated yield-bearing gateway for institutions wanting into the Ethereum ecosystem?
Or is it something else?
Or, when you peel back the layers, is it just a very high-stakes, super concentrated bet on one single, very volatile digital asset, and maybe wrapped in a complex financial structure that could, well, amplify both the good and the bad?
That is the $2.24 billion question, isn't it? So just to set the stage for everyone, Dynamix is currently a SPAC, a special purpose acquisition company.
Basically a shell company on the stock market.
Right, a publicly traded shell just waiting for this deal to happen. Our analysis date is October 3rd, 2025, and the stock closed at $10.59.
Now here's the kicker. Its current market cap is only about $234 million.
But, and this is huge, its post-merger net asset value, the NAV, just from its crypto holdings alone, it's projected to be over $2.24 billion.
Yeah, that massive, almost 10x gap. That's what we're here to unpack today.
And just before we jump into the deep analysis, a quick reminder for you listening. If you like what we do here, please hit like and subscribe to Stock Analytics AI on YouTube. Our members, for just $4.99 a month, get priority deep dives on tickers they choose.
And we're actually covering all the S&P 500 stocks over the next few months, so members get exclusive priority access to those too.
If you just want a one-off deep dive on a specific stock, you can always drop us a super thanks on YouTube. Okay, let's dive in. Chapter 1. Business understanding. Let's start with the business model itself, because the Ether Machine is, well, radically different from a traditional company.
Oh, absolutely. It's described as a purpose-built digital asset treasury. So forget manufacturing, forget services. This is something else entirely.
So what's the engine? How does it actually generate revenue?
It's an active strategy, very productive. They don't just sit on Ethereum, they make it work for them. The core model, it really boils down to two main streams: staking and restaking.
Okay, let's break that down. Staking.
Staking is the foundation. They commit their ETH, the ETH on their balance sheet, to help validate transactions on the Ethereum network.
Right, securing the network.
Exactly.
Yeah.
And in return, they get native rewards paid in ETH. Think of it like earning interest directly from the protocol itself. Almost like a high-tech savings account, maybe.
Okay, that makes sense. And restaking, that's where they're trying to get an edge, right?
That's where they aim to generate alpha, yeah.
Mm-hmm.
Restaking means taking that ETH that's already staked
Mm-hmm.
and using it again at the same time to help secure other adjacent protocols. The big example everyone talks about is the eigenlayer ecosystem.
So it's like using your house to secure its own mortgage, but also using it as collateral for your neighbor's project to earn extra income.
Huh. That's actually a pretty good analogy.
Yeah.
Yeah, you're earning that base staking yield and then this extra layer of yield on top by providing security elsewhere. It's clever.
And they've already shown some proof of concept here.
They have. Early results generated 1,350 net new ETH, which was valued at about $5.6 million at the time. So, it works.
Which brings us back to that key question. Why would an investor buy this stock, ETHM, instead of just, buying ETH directly?
And that's the core value proposition. The stock is the product for public investors. It offers regulated, liquid exposure. You can buy and sell it easily on the stock market.
To professionally managed yield-generating ETH.
Right. And it takes away all the complexity. You don't need the technical know-how. You don't have the security headaches of self-custody. You don't need to run a massive, complicated staking operation yourself. ETHM handles all that.
And they're not starting small, are they?
Not at all. Their ambition is huge, to be the largest public Ether generation company.
Mm-hmm.
They're launching with roughly 495,362 ETH right on the balance sheet.
Wow. That immediately puts them
Where?
in the global rankings.
Third largest corporate holder of Ethereum globally, right behind Bitmine Immersion Technologies, BMNR, which has about 2.1 million ETH, and SharpLink Gaming, SBET, with around 837,000 ETH.
So they're jumping straight into what the sources are calling this acquisition race for corporate crypto treasuries.
Precisely. But what makes them different, or what they're signaling is different, is this focus on institutional rigor. Look at who they hired as their auditor, KPMG.
That's a big Wall Street name. Definitely a signal.
A massive signal. They're saying, we intend to play by the highest standards of compliance.
And they seem to be catching some regulatory tailwinds, too. Mention of the U.S. Genius Act.
Yeah, that's establishing a federal framework for stablecoins. That's generally seen as positive for Ethereum because, well, Ethereum's where most stablecoins live. It has legitimacy.
And barriers to entry for anyone trying to copy this must be enormous.
Absolutely huge. We're talking $1.5 billion in committed capital just to get started, plus you need incredibly deep technical expertise. It's not something you can just spin up easily.
Chapter 2. Management Evaluation. The Ethereum Avengers. Okay, let's shift from the machine to the people running it. They're calling the leadership the Ethereum Avengers.
Yeah, catchy name. But it reflects this interesting dual leadership structure they have. It seems quite symbiotic.
On one side, the CEO, Andrea Bernatova, what's her background?
She brings the traditional finance muscle, execution expertise.
Yeah.
Came from Morgan Stanley, Blackstone. And she actually has a successful track record with a previous SESMAC merger back in 2024. So she knows the public market game.
Okay, the Wall Street credibility. And the other side?
That's Andrew Keys, the chairman. He's the crypto-native visionary, former head of global business development for Consensus, co-founder of the enterprise Ethereum Alliance. People call him an original believer in Ethereum.
So you've got the seasoned finance exec paired with the deep crypto insider. That blend does sound powerful.
It really could be a bridge between those two worlds.
And what about how they plan to run the company, specifically capital allocation?
It's laser-focused. Acquire ETH, manage ETH, generate more ETH. That's it. Their war chest is substantial, $800 million from that PIPE EE financing we mentioned.
Private investment in public equity.
Right. Plus those significant in-kind contributions from the founders themselves.
Let's talk about shareholder alignment, because this seems unusual. They're not paying cash dividends.
Correct. The stated goal is purely accretive capital strategies. What that means is they plan to retain and reinvest 100% of the yield, all the new ETH they generate back into the treasury.
Why? What's the goal there?
The idea is to steadily increase the amount of ETH owned per share over time. So your slice of the pie keeps getting slightly bigger in ETH terms.
And the alignment isn't just strategic, it's personal. You mentioned the in-kind contributions.
Yeah, this is where it gets really compelling for alignment. The founders, Keys and Bernatova, didn't just put in cash. They contributed massive amounts of their own ETH directly to the company's balance sheet.
How much are we talking?
Keys put in roughly 170,000 ETH, and Bernatova around 150,000 ETH.
Wait, hold on. Over 300,000 ETH personally. That's not just skin in the game.
No, that's like their entire financial being is tied to this. Their success is the success of the ETH treasury growing. You can't get much more aligned than that.
Okay, that's a powerful statement. And is this expertise showing up in performance yet? How do we measure that?
Well, the conceptual return on invested capital, or ROIC, here is really the annualized percentage yield they generate on their ETH treasury.
And the early signs.
Very positive. The sources highlight that their validators, the systems doing the staking work, already rank in the top 5% across the entire network for staking reward efficiency.
Better than average.
Significantly better.
Yeah.
The network average APY is somewhere between 1.9% and 3.5%. Being in the top 5% implies they're generating measurably more yield from the same amount of staked ETH. That's tangible alpha.
Chapter 3, Financial Analysis. Valuing a digital treasury. All right, this brings us to the valuation puzzle. Because it's a SPAC merging with this huge digital treasury, the standard finance playbook kind of goes out the window, doesn't it?
Completely out the window.
Yeah.
That $234 million market cap right now, that's just the SPAC shell. It tells you almost nothing about the underlying business yet.
Right, so historical metrics like PE ratios?
Totally irrelevant.
Yeah.
Non-existent, actually.
Uh-huh.
Future revenue isn't dollars, it's ETH-denominated yield. Future free cash flow is basically the net new ETH generated.
So we need a different yardstick. The sources focus on the market cap to net asset value, M&AV ratio.
Exactly. That becomes the key relative metric. You're comparing the market price to the actual underlying value of the assets, which in this case is overwhelmingly the ETH they hold.
And we keep coming back to that staggering gap. $234 million market cap now versus a post-merger NAV north of $2.24 billion.
There's a huge disconnect.
So if the assets are worth almost 10 times the current stock price suggests, what is the market actually pricing in? Is it just general crypto fear or something specific to this deal?
It's likely a combination, but a big part of it has to be execution risk. Specifically, the risk that the SPAC merger doesn't close for some reason.
Ah, the deal risk itself.
Right, and maybe some skepticism about valuing a single asset entity, even one generating yield, but financially, they're launching clean. That PIPE financing was all common stock.
Meaning no interest-bearing debt.
Correct. Low financial risk from a debt perspective at launch. The risk is tied to the asset and the deal completion.
Okay, so if PE is useless, how do we even attempt to find an intrinsic value? The sources mention an educational model, a yield-based discounted cash flow, DCF.
Yeah, it's more of a conceptual exercise, but it's interesting. The core idea is you project the future stream of net ETH rewards.
Not the dollar value.
Not initially. You project the ETH they'll likely generate through staking and restaking year after year. Then, you convert that future ETH stream to dollars based on some price assumption, and then you discount that future dollar value back to today's terms.
Okay. What kind of assumptions go into that? Must be sensitive.
Extremely sensitive. Key assumptions are the growth rate of that ETH yield. The model uses a baseline of maybe 2–3% from staking, plus potential alpha from restaking, and crucially, the discount rate.
How high does that need to be?
Very high. The sources suggest somewhere between 20% and 30%.
Wow, that's a high bar. Why so high?
That reflects the inherent risks. The extreme volatility of ETH price, potential protocol risks, smart contract risks. The market demands a high rate of return to compensate for that uncertainty.
But even with that high discount rate, what did the model suggest?
Even discounting heavily, the model still pointed towards an estimated intrinsic enterprise value in the range of $2.54 billion to $2.74 billion.
So still significantly higher than the current implied NAV, let alone the SPAC market cap.
Exactly. It strongly suggests that if this merger completes successfully and the NAV becomes fully recognized by the market, there's potential for a massive re-rating of the stock price upwards.
Chapter 4, Market Sentiment. Okay, let's shift to look at market dynamics and how this whole thing is perceived. What's the sentiment out there?
Well, officially, there's no analyst coverage specifically on ETHM yet because the merger isn't final.
Right, it's still technically Dynamix Corp, the SPAC.
Exactly. But we can look at the underlying asset Ethereum as a proxy. And the outlook there is pretty strong, according to some analysts.
Like a
Standard Chartered analysts, for instance. They reportedly raised their year-end 2025 ETH price target to $7,500.
$7,500, that's quite bullish.
Very. And interestingly, they specifically cited corporate treasury buying exactly what the Ether machine is doing as a key catalyst driving that forecast.
So the narrative fits. What about the media tone around the deal itself?
Overwhelmingly positive, from what the sources indicate. Most coverage focuses on the sheer scale that $1.5 billion in committed capital really grabs headlines.
And the milestones they're hitting?
Yeah, things like successfully filing the confidential Form S-4 with the SEC. That signals the merger process is moving forward, which the market likes to see.
Any significant negativity? Are people betting against this?
Doesn't look like it.
Yeah.
Short interest is extremely low, less than 0.4% of the float. That means very few traders are actively betting the price will go down. The market isn't fighting the merger's success, it seems.
And technically the stock price itself.
It's been hovering, slightly below its 50-day moving average, about 4% down from that, but it's still holding above its longer-term 200-day moving average, up about 1.8% from there. So kind of consolidating in a longer-term uptrend.
Chapter 5, Ownership Structure. Now, who actually owns this thing or who will own it post-merger?
That's undergoing a big shift. Right now, being a SPAC, it's likely held by arbitrage funds like Linden Advisors or Glazer Capital, who play these short-term merger situations.
But that changes dramatically after the deal closes.
Completely. The structure will become dominated by long-term strategic investors. The sources emphasize will be highly concentrated ownership among what they call strong hands.
People who are likely to hold for the long term.
Exactly. And we know who some of the key strategic investors are, the ones who participated in that crucial PIPE financing.
Who are they? Any big names?
Oh, yeah. Blue chip names in the crypto world. Kraken, the exchange. Pantera Capital, a major crypto VC. Blockchain.com, another big platform. And Electric Capital, another well-respected crypto fund.
Wow. Having those kinds of players backing the deal is a massive vote of confidence.
It really is. It endorses not just the strategy, but also that management team we discussed.
So what's the estimated breakdown after the merger? Pro forma ownership.
The estimate is that institutions, including those PIPE investors, will hold about 63.51% of the company. And insiders, like the founders contributing their ETH, plus other individuals, will hold around 25.000%.
So very concentrated among institutions and insiders. That suggests stability, potentially?
Chapter 6. Risk assessment. Okay, this brings us to the crucial part, weighing the pros and cons. The risk assessment. We need to be balanced here.
Absolutely. Let's start with the strengths. What's the core bull case built on?
Well, number one has to be that world-class management team, the Ethereum Avengers blend of finance and crypto expertise. That's a huge asset.
And the scale.
Immediate, massive scale. Launching with nearly 500,000 ETH is unprecedented for a public company like this. And third, that unique yield-generating strategy. Staking plus restaking offers a compounding effect that's structurally, well, arguably superior to just passively holding ETH in an ETF.
Okay, those are compelling strengths. What about the weaknesses, the internal hurdles?
The elephant in the room is the extreme single-asset dependence. This company's entire fate is tied to the price performance of Ethereum, full stop.
If ETH crashes, the NAV crashes.
Exactly. Also, this specific business model, a public company focused solely on generating yield from a crypto treasury. It's basically unproven under the harsh glare and quarterly demands of the public markets.
That's a fair point. Anything else on the weakness side?
The complexity of the spec structure itself. While they avoided debt, there's still potential dilution down the road from things like warrants or earn-out shares given to early investors or sponsors.
Can you quickly explain what that means? Dilution?
Sure. Warrants are like options that give holders the right to buy shares at a set price later. Earn-outs often give sponsors extra shares if the stock hits certain price targets. If these get exercised or triggered, it increases the total number of shares outstanding.
Meaning each existing share represents a slightly smaller piece of the company.
Precisely. It can dilute the value for existing shareholders.
Okay, now opportunities. The macro winds blowing in their favor.
Big ones. Continued institutional adoption of crypto, specifically ETH, as a treasury asset is a major potential tailwind. The ongoing expansion of the entire Ethereum ecosystem, DeFi, Layer 2 scaling solutions, NFTs, that creates more demand and utility for ETH.
And the chance for the team to use those new yield strategies like restaking.
Yes, the opportunity to actively generate alpha, to outperform just holding ETH, using sophisticated strategies like restaking within ecosystems like Eigenlayer. That's a key part of their value proposition.
All right, finally, the threats, the external headwinds they face.
Intense competition is one. We mentioned that acquisition race with BMNR and SBED and potentially others wanting to build corporate ETH treasuries.
Technical risks, too.
Definitely.
Oh.
A big one in staking is called slashing. This is where, if their validators mess up, go offline, validate incorrectly, the network can actually penalize them by destroying a portion of their staked ETH.
Ouch. So operational failure has direct financial consequences.
A very direct one. And of course, there are always custody and security risks when you're dealing with billions of dollars worth of digital assets. Hacks, lost keys. They need Fort Knox level security.
So if you had to synthesize all that risk down, what's the biggest, most significant threat?
Well, the operational risks, like slashing or security, seem largely mitigated, or at least manageable, given the expertise of the team they've assembled. They should be good at that. So the most significant and unavoidable threat remains macro correlation, a dramatic, sustained plunge in the price of ETH, driven by wider market forces completely outside of management's control. That would be devastating to their NAV and likely the stock price.
So, bottom line for investors, you're placing a bet heavily influenced by the future price of Ethereum, managed by experts who aim to generate extra yield on top.
That's a good summary. It's a leveraged, professionally managed bet on ETH's trajectory.
Chapter 7, conclusion. Okay, let's try to bring this all together. Synthesizing the bull case.
Premier team, superior compounding strategy aiming to increase ETH per share, unmatched launch scale, and a potentially powerful macro tailwind from institutional adoption.
And the bear case.
Extreme asset correlation and volatility risk tied to ETH price, an unproven model in public markets, and the execution risk and complexity of finalizing and operating post-SPAC merger.
And valuation-wise, we keep coming back to that $10.59 price being almost like an option on the deal's success.
Right. It's pricing in that uncertainty. A successful merger where the market fully recognizes that $2.24 billion NAV is widely expected to trigger a significant, perhaps immediate, re-rating of the stock.
So the investment's ultimate success seems to hinge on two distinct things, really.
It does. First, the management team's ability to execute their yield strategies effectively to actually generate that alpha. And second, the long-term price trajectory of the Ethereum network itself. Both need to go right.
Which leaves us, and you the listener, with a final provocative thought to mull over. Given the undeniable world-class expertise of this management team, their proven ability, even in early stages, to generate efficient yield, how much is that specific skill worth? How much value do you put on their alpha-generating capability versus the unavoidable, potentially huge volatility risk of the underlying asset they hold? Which force expert execution or macro price swings will ultimately dictate this stock's fate?
That's the multi-billion-dollar question indeed.
Something to consider as you do your own research. And if you found this deep dive valuable, please subscribe to Stock Analytics AI on YouTube. Remember, our €4.999 members get priority deep dives, and we're covering the entire S&P 500 soon with exclusive member access. A super thanks also works for one-off requests.
And finally, the necessary reminder. This analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be taken as financial advice. Always conduct your own thorough due diligence and research before making any investment decisions.